Let's talk about miners and
What's
how
going on
they
with the
seem to be
miners?
just selling every Bitcoin in their wallets. Miners are selling at a rapid pace. They sold about 14,000 Bitcoin in a single day, equal to over $300 million. And miners just across the board, public miners especially, have been dumping Bitcoin.
Do you know how miners and the pressure they're under when the price goes down? Do you understand how that works?
A little bit. Could you explain it in a little more detail?
So if you think of miners, right, the whole name of the game for a miner is to go find the lowest cost power possible, go find machines for as low as possible. Those are their input costs, essentially, right? It's the cost of the machine, cost of the energy. They then plug them in and they mine Bitcoin. That Bitcoin usually is produced or mined at a cost to them that is lower than the current price. So we'll use an easy example. If Bitcoin was trading at $40,000, miners may mine it at $10,000 cost to them. So they spend $10,000 for every one Bitcoin they mine. Now, I'm overgeneralized numbers. If Bitcoin is trading at $40,000 and it only costs you $10,000, that's pretty good. It's $30,000 worth of profit for every Bitcoin you mine. Now, that is for the absolute best miners in the world, those with the lowest cost power or access to the best machines at the best price. There are some miners, specifically usually the residential miners, individuals, they may have a higher cost of power. Sometimes, let's call it 4 times higher. So instead of paying 3 cents a kilowatt hour, maybe they're paying 12. And so in that situation, it costs you $40,000 to mine one Bitcoin that equals $40,000. Well, the problem becomes if Bitcoin's price drops. Now, all of a sudden, you're spending $40,000 to mine a Bitcoin that, let's say, now is trading at $30,000. So what do? Either you continue to mine Bitcoin at a loss or you shut off your machine. Now, because it's residential, they don't have a lot of miners. So what do? They shut off. Not a big deal to the network. But if the price continues to fall and now it's trading at $20,000, those miners with the lowest cost power and the best priced machines, they can continue to mine because they have a $10,000 production cost for a Bitcoin that's trading at $20,000. But one of the challenges is that these miners, their expenses are denominated in dollars. So, as an example, let's say that you were able to mine $1 million worth of Bitcoin per month when Bitcoin was at $40,000. And your expenses were $700,000 a month. You had a $300,000 profit and all was good in the world. If now all of a sudden Bitcoin's price goes from $40,000 to $20,000, you went from making $1 million in revenue to $500,000 in revenue. Well, if you're making $500,000 in revenue and your expenses, which are denominated in dollars, is still $700,000, you now are unprofitable. So what do? What many of the miners will do is they will sell Bitcoin that they've been accumulating on their balance sheets to be able to raise cash so that they can pay, 1, their expenses, and 2, is to ensure that regardless of how low Bitcoin's price goes, they won't go bankrupt. They won't go out of business. And so naturally, as the price falls, some portion of miners become forced sellers because they've got to raise cash on the balance sheet. Now, one argument is that this is a positive thing because the miners are being able to protect themselves. Another argument is, no, the miners should actually do everything possible in their power to never sell the Bitcoin. The whole point of mining is if you can mine Bitcoin, even if it's at a profit today, and hold it for a really long period of time, it's supposed to go up in value. And so naturally what you're seeing is miners, as the price fell down in June and when it broke $20,000, lots of miners were selling. And they've continued to sell because they need cash.
Yeah, but when you look at it, the big guys obviously are hoping and trying to weather the storm, it seems like, right?
Yes.
Like they're the ones selling off Bitcoin. They're the ones that have the most machines, have the cheapest power, all that stuff. But when you look at retail, what should the average person do? Should they just turn off their machine? If they're losing money every single day the machine's on, like that's the ultimate question, I think.
Well, there's some people who are not economic actors in mining. Some people, they just like the idea of mining and they're going to do it regardless. They feel like they're contributing to the network, right? There's some people who say, I don't care if I lose a little bit of money now. I already have a sunk cost of the machine. I already spent money on the machine. The second thing is I just tapped into the electricity in my house or I'm doing it in my garage or something. So yes, I'm paying 12, 13, 14 cents a kilowatt hour, but whatever. It's not like I have like a special agreement, or whatever. It's just my electrical costs at my house. And then, I'm going to just mine the Bitcoin. And if I hold it for long enough, then eventually the Bitcoin will be worth more than it is today. And so, yes, I'm losing money in the short term, but I already bought the machine, so I should just keep mining. And then there are the people who are the economic actors who say, like, why am I mining Bitcoin at a loss? If I'm going to deploy more dollars, then I should just go buy Bitcoin rather than buy more mining equipment.
How much of this is energy costs versus Bitcoin price?
So for those that are unaware, those are two main components. There is a third thing that is important here. So you have the energy cost, which is fixed, right? Most people don't go to their power provider and say, "Hey, Bitcoin was at 40,000. I was paying 5 cents a kilowatt hour. It dropped to 20. I'm gonna have to have you hook me up with 2.5 cents, right?" It's just like you pay 5 cents. This is why miners are obsessed with how do you get the lowest cost power, because one, it optimizes your profitability, but two, it acts as protection when Bitcoin's price turns down. Second thing is obviously Bitcoin's price. But the third thing is the difficulty adjustment. So if you go back to May of 2021, when about 65% of all hash rate was in China, specifically one province said, "Hey, get the hell out of here. We're serious this time." And about 50% of all hash rate on the Bitcoin network left. And so they unplugged their machines and moved them elsewhere. Sometimes they didn't actually go plug them in anywhere else. Other times they moved them and they ended up plugging them in. When we had a 50% drop in the hash rate because of that China ban, what we saw was the difficulty adjustment went down, meaning that if there's 100 people trying to mine, right, then the difficulty adjustment, let's just say, is kind of flat. If all of a sudden there was 150 people trying to mine, the difficulty adjustment would go up because it's trying to make it more difficult for any one miner to win, right? There's more competition. If all of a sudden we went from 100 miners down to 50, the difficulty adjustment would adjust downward because it wants to make it easier for those 50 to go ahead and do it. Now, why would you do that? If it's easier, what does that act? It acts as an incentive. The easier it is to mine, the more people want to mine. So it brings back a ton of miners. If all of a sudden there's tons and tons of miners and it's really difficult, the next incremental miner, it isn't as attractive to them, right? Or it's less attractive than it was before all those miners showed up. So naturally, that difficulty adjustment acts as almost like a regulator, right? Or like a balancer in terms of always ensuring that as miners shut off their machines because the price is going down, the difficulty adjustment moves downward as well to ensure that miners always want to come onto the network. And so that balancing mechanism is what prevents this idea of like a mining death spiral, which there is an idea of like, well, if you have miners who all of a sudden flip to losing money on each Bitcoin, they would shut their machines off. So the network would grow less and less secure. And then they would need to sell their Bitcoin in order to be able to fund, expenses. And that would then push the price further, which would cause more miners to shut down, which would cause them to sell more Bitcoin. And like you would get in this death spiral on the way down. The difficulty adjustment is what helps to prevent that from actually occurring.
How do you think about, is the ultimate goal just as many miners on the network as possible, or does the difficulty get too high to where it's like not economically sound for so many retail miners that like the big boys are playing the whole space and there's no room for any like retail miners?
There's a relationship between price and hash rate, right? Mm-hmm. Hash rate is the measurement of how many miners, how many computing powers on the network. Some people will say hash rate leads price. Some people say price leads hash rate. Chicken or egg, right? Depending on who you talk to. But I do think that there's a very important part of the Bitcoin network is ultimately secured by the miners. Now, the nodes technically are validating the transactions. And so we want as many miners as possible because that means that the network is more secure. Now, one of the things that has occurred is obviously 65% of the hash rate was in China. Now, all of a sudden, about 10% or so is the latest estimation I saw. 10% of all hash rate globally is in Texas, and about 30 to 35% of all hash rate globally is in the United States. Now, 35%, let's call it, is better than 65% in any one country. But I think we have to be careful that we don't over-rotate from 65% in China to 65% in the United States either. Like, we actually want a truly decentralized, distributed network where folks feel like there is no ability for one country to unilaterally act to shut down miners.
All right. What are your thoughts on like, obviously, a bunch of retail miners have loans, it seems like, to pay for these machines, and then payments are recurring every single month. They still have to pay those. Those are the fixed costs. Like, how should someone think about, okay, I have a loan, but I'm still mining at a loss. I have conviction, but I still don't know when that will happen. Like, what's the time frame of all of that? Like, how should they think about that?
Yeah, it's kind of like leverage, right?
Yeah.
It's almost worse than leverage, which is In leverage, you have the ability to liquidate the asset, right? Like if I, use an easy example, if I borrow $100,000 to buy Bitcoin and I posted $200,000 as collateral, I basically can weather, 30, 40, 50% drawdown before I would get liquidated. But if at any point I'm like, oh shit, I think the Bitcoin price is going down, I can just, with the click of a button, sell the Bitcoin, pay off the leverage or the loan, and I still have some Bitcoin left. But there's a 24/7, 365 highly liquid market that I can do that immediately, right? If instead I basically took a loan and I didn't go buy Bitcoin with it, I bought mining equipment, and I want to quote unquote liquidate to be able to pay off the loan because the price is dropping, it's not as easy. It's not a 24/7, 365 highly liquid market where I can just press a button and bam, the miners are sold. And so I think that ends up being one of the difficulties there. Now, if you're a large scale miner, you've got a big balance sheet, you've got access to capital markets, and you're able to kind of in a sophisticated way get access to debt to be able to finance this stuff, sure, there's plenty of people who will go do that, right? Debt is a component of businesses all in every industry.
Yeah, I agree. And we've actually seen the cost of miners has dropped, obviously, in correlation with price going down, miners getting off the network. They're selling their machines. They don't know what to do with them.
I don't know what it is now. It used to be like the S9s. That was when I first started mining. That was the best piece of equipment at the time. Now, pretty much no one uses those. They essentially would price them based on what they thought it would take 9 months or so to mine back your money. Gotcha. So they would say like, okay, cool. If you use this machine and you mine for 9 months, you'll make $3,200. So then they would sell it for $3,200, right? And then I think at some point it went from 9 to maybe 12 months or whatever. But basically it was like, we want to price the equipment so that you can buy it. If you plug it in today and you mine for 9 to 12 months, you'll get your money back. And so naturally, if the price of Bitcoin goes down, well, they have to drop the price of the miners, right? It's also a function of if the price of Bitcoin goes down, people are less excited, so there's less demand for mining equipment. If the price goes up, though, it is bananas, right? There was S9s. I'll probably mess up the numbers, but I think it was like $1,200. Maybe it was like the average price. And at one point, people were buying S9s for like $3,000, $4,000 during the 2017 bull market.
Gotcha. Yeah, bringing up a chart now. All right, whatever. Can you talk about the miner capitulation? Like, I've seen that all over Twitter, obviously.
That's what we were talking about. Yeah. Is basically miners saying, yo, it's over. Like, I got to shut off my machines. I got to sell my Bitcoin because I have dollar-denominated expenses. And so the whole idea of miner capitulation is basically similar to what we saw on the trading side, is at some point there had to be liquidations, right? There had to be people like, damn, it's over, it's done, right? And so naturally what you get in those situations is on the miner side, same thing. You get people shutting down their equipment, you get them selling their assets, and it's either because they're forced sellers, which is the equivalent of being liquidated if you had like leverage or something, or two is psychologically they think it's over. Now, I don't think we're getting a lot of psychological capitulation, right? I actually think it's the exact opposite. People are like, damn, this is annoying, but like they have long-term conviction in the asset and in the market. I do think that there's a lot of forced selling. So in June, if you remember, Bitcoin's price drew all the way down to 17,500, significantly below the realized price on chain, and a number of other metrics. It was the first time in Bitcoin's history that Bitcoin had dipped below a previous all-time high after a bull run. And so there's a lot of miners, just a lot of pressure. And so what were they doing? That's where you saw the miners selling pretty much from June 1st till today. They're just forced sellers.
Now that we talked about retail, I want to talk about like the big boys, right? So they sold a lot of Bitcoin in July versus June. They sold about 23% of their holdings, public miners. Does that worry you at all?
That they're selling so much of their
Bitcoin?
They're
selling 23% of the overall holdings.
Is better than selling 50%. Right. Again, what they're trying to do is they're trying to play a game of how much do we have to sell? But if you were to go ask them like, hey, wave a magic wand, do you want to sell any Bitcoin? They'd say no. Right. And so, yeah, look at these numbers here. Bitcoin sold in June, the top 5 Bitcoin sellers in May and June in public miners. Core Scientific between May and June has sold 9,900 Bitcoin, right? Just under 10,000. Bitfarms, Northern Data, Argo, and CleanSpark have sold between, call it 538 and 3,300 Bitcoin. And so when you look at this, in many cases, the selling in May was much smaller than the selling in June. Why are the percentage in June versus May so high? It's because they were forced sellers. Right now, forced sellers doesn't mean that like the business is bad or it's going to go out of business or whatever. It just means that they are having to sell Bitcoin to make sure that they have a strong enough balance sheet that they can fulfill their U.S. dollar denominated obligations, and they want to make sure that they're going to survive. Because the name of the game in bear markets is to survive, and the name of the game in mining is to mine as much Bitcoin as possible and never sell it. Right? Those are like the two strategies that you'll see people kind of talk about who've been around for a while. When you see miners selling, it just means that they're selling because they have to, not because they want to, in most cases.
Yeah, and then how do you think about the transaction fees that they're receiving, right? So having more machines on is good because you're getting more money, right? But you could be operating at that loss. So like, should they think about plugging in more machines if they really have that much conviction, right? Like none of this financial advice, but
yeah, most miners, I think, look, they do inside of a block. You basically get the mining reward. There's some transaction fees as well. The idea is 2140. All the Bitcoin will be mined, and then the network will be sustainable on transaction fees at that point. There's plenty of people who argue that are critics that say no, that's not possible or whatever. When you begin to look at what miners are doing, I don't know very many miners who are like, yo, let's go set up more miners because we're going to get more transaction fees, right? The way they look at it is that Bitcoin reward is going to end up being the big incentive, if you will. And then on top of the Bitcoin kind of block subsidy, you also see miners who say to themselves, how do I manage my balance sheet? I know what my dollar denominated obligations are. If I have to mine at a loss and I got a really, really big balance sheet and I've got deep conviction in Bitcoin and I'm basically taking a directional bet that, within 12 months it'll recover, then maybe I go plug them in. But if I don't have a big balance sheet, if I'm not coming at this from a position of strength, maybe I don't go plug in new machines. Maybe I don't put in that new order because I need to be able to ensure I'm going to get to the other side. Like rule number 1 is survive. Rule number 2 is get as much Bitcoin as possible. But you don't focus on number 2 if you're not sure you're going to actually fulfill rule number 1 of make sure you survive.